So our next guests are two internet pioneers, in fact, early entrepreneurs and investors who've been around, knew this space even before crypto came along, but they saw the vision very early when it came to crypto. And so I want to welcome to the stage Glenn Hutchins, who is the CEO and founder of North Island Ventures, Jeremy Allaire, who is the CEO of Circle, and they'll be introduced by Christine Lee, who is our moderator today, and she's a CoinDesk TV anchor. So Christine, let's bring out Glenn and Jeremy and dive into a rich discussion about what happens when money actually goes digital.
Good morning, Austin. Good morning, Consensus.
Thanks.
Woo! Thank you for the energy. Thank you for that introduction, Michael. We've got a wonderful panel before us. We've got Jeremy Allaire. He is the CEO and founder of Circle, the second largest builder of the second largest stablecoin, USDC, an early internet entrepreneur as well, an OG in the space. And we've got Glenn Hutchins, who is also a OG in crypto, but also even way back further. He was into fintech before fintech was cool. He served 9 years on the New York Federal Reserve. He is a prolific investor in financial services, and he joins us as well. And so I guess the first question we want to ask, when are we going to make crypto as easy as sending email, crypto payments as easy as sending an email? And when you first set out your vision in 2013 and starting Circle, did you see it to where we are today? Or what do you see that is wanting?
Yeah, that concept was one of the founding principles behind Circle when we started the company in 2013. And we really thought that eventually, and it wasn't possible in 2013, but eventually you could have a protocol for dollars on the internet. We have the web protocols, we have the email protocols. They let us exchange information and data and content and communications instantly, globally, for free. We thought there ought to be, what I called an HTTP of money, like the web protocol, but like a protocol for money. And in our mind, it was, the idea of taking what we think of as traditional money, like government debt money, liabilities of a central bank money, and expressing that as a cryptocurrency, and then making it work on these networks. And the idea was that if you could do that effectively over time, it would be kind of like the physics of the internet. It would drive the cost towards zero, and you would have the same kind of open, interoperable, frictionless way to move value that you have with information. And so that was the idea. And in terms of seeing it, yeah, we saw that becoming possible, and now I think we're really close. It is actually here today, meaning you can use dollars on the internet in this way with things like USDC, and and that's growing fast, and we're getting really close to the cost getting close to zero, and we're getting really close to like major consumer applications kind of connecting this up to make it something that just everyone uses every day.
Certainly the rise of stablecoins, particularly USDC, has brought us closer to there, but what do you see as the obstacles that still lie in the way?
Yeah, I'm a technologist first, so I first think about the technology problems that have to be solved, and I like to refer to kind of where we are in blockchain as sort of, we're in that dial-up to broadband phase, where, remember the dial-up internet, and you could only do certain capacity, and then people built out the new capacity, and you had broadband, and then all of a sudden you could do all these things that you were originally promised you could do. Third generation blockchains, which are really a very competitive market. These layer 1 blockchains are coming online. We've launched USDC on 9 blockchain protocols. We're going to launch it on more. And now those are kind of like the broadband coming online. So one is just having scalable, low-cost global infrastructure that makes that possible. So that's one problem. Another problem is just what I call the user experience problem, which is that for the average person, cutting and pasting a public key address, the risk of fat fingering that, knowing what this stuff is, not going to work. Yeah. And so we have to solve the UX problem, and that's the good news is that's a much easier problem to solve than like scalable layer one infrastructure. And so there's a lot of great companies working on that. And there are great traditional companies like the Squares of the world and others that are sort of wiring up to crypto. And so we're going to get incredible user experiences that work as seamlessly as anything else, like an NFC payment or QR codes and things like that. So we're going to get that very soon.
How are you going to get the fees down?
Well, I mean, fundamentally, if you have an on-chain dollar and the transaction cost is the cost of the blockchain transaction itself, you're now, on third-generation blockchains, transaction fees are, from a 20th of a penny to a few cents, and so it's down. That's today, and that will only continue to improve as the build-out, that kind of capacity build-out happens. So I think we've already gotten there. It's wiring up the user experience, and then final piece, and I'm sure we'll come back to it, is we have to have well-defined national-level statutes around stablecoins, because households and firms and financial institutions are not going to adopt this at scale until they know what the heck these things are and that they're something that they can put on their balance sheet and understand and use. And so we're really close to that as well. And so as those things happen, then I think we can get to 1 billion users.
Have you had a chance to look at Senator Gillibrand and Alamus's legislation and perhaps your thoughts on some of the provisions that they wrote about stablecoins? Do you agree?
Yeah, I think there's a lot of very good proposals there. I think there are many good proposals. They have good proposals. Senator Toomey has good proposals. There are proposals from the Democrats and Republicans. This is a bipartisan issue, and you're seeing bipartisanship around it. So that's very encouraging. You don't see that a lot in Washington. You're seeing it in this topic because everyone understands you need to have a good set of policy on stablecoins.
They want more disclosures. They want you to be able to redeem at par.
Yeah, so the good news is the way we launched USDC from day one was as a regulated dollar digital currency that has supervision by banking regulators, that has statutory consumer protection requirements, all these things. You want to codify that at a national level, and you want to make sure everybody follows those rules. So that there's not a gap in the system that could introduce the financial stability risk and other risks that people are concerned about.
Let's bring Glenn into the conversation. So you have mastered financial services throughout the year. So when looking at the crypto industry, what do you see in terms of what interests you in cryptocurrencies, and how will it penetrate the incumbents that are currently existing in the financial services world?
Okay, thank you. So full disclosure, I have an investment in Jeremy's company, so everything he says is right. And I want him to be enormously successful.
Thank you.
He's also on the board of Digital Currency Group, which is the parent company of CoinDesk.
Full disclosure, I'm also on the board of the parent company for this organization. Maybe that's why they got me here, who knows. My interest has moved beyond payments. I came into crypto world from the fintech world, seeking to disrupt the payments industry, which had not been disrupted yet. The credit card industry, remittances, foreign exchange, that kind of thing, which had been immune to disruption. And that was hence one of my first investments was in Circle, because I thought Jeremy was on that path. My interest has evolved. I think everything Jeremy just said is right, so this is not meant to contradict him. But I've discovered that in the Bitcoin world, I've concluded in the Bitcoin world, because of the design of the technology, particularly around the mining, that it's too expensive and too slow to really be a payments modality at scale. But though Jeremy's, the stablecoin piece of this is a really important piece to get there. But my mind has gone to marketplaces that are driven by proof of stake that are cheaper. Then, by the way, having invested in new technologies over the course of my career, what happens next is not a direct replica of what happened before that. What you do is you obsolete the prior economy by reconceptualizing it.
Totally.
Right? And so the reconceptualization here is it's not about something that looks like credit card payments or remittances, in my view. Exactly. Inside these non-fungible networks like Flow, you have payments that happen inside those networks as a consequence of what people are doing inside that network. So people go into the Flow environment to buy and sell NBA Top Shot trading cards. And they compensate each other inside that environment to engage in that form of commerce. And then when they exit from that environment, they then take the flow tokens and turn them into USDC and then enter the rest of the economy. So that's how I think about it now. It's not something that looks just like credit cards. The way to think about cryptocurrencies in my mind is not as a new form of money, but as a new type of commerce, a new paradigm of computing, and a new form of corporate organization. And if you think about it from that perspective, the possibilities are endless. And so my interest in finance is something that looks more like decentralized finance today. Individual marketplaces or communities that can engage in financial types of transactions based upon smart contracts, not purely payments. Does that make sense?
Yeah, how will traditional financial services survive in that new paradigm? Will they have to innovate to survive or get left behind?
There's a huge issue out there associated with their regulatory barriers to entry that they have as large enterprises, and they will use the regulatory barriers to entry to keep themselves protected by that moat they can build around them. But I would just say, as technology evolves, IBM didn't become Microsoft. Microsoft didn't become Google. Google didn't become Facebook. Facebook didn't become Amazon, and Amazon's not going to become Circle or Coinbase. The world evolves, and the legacy competitors typically get defined away because the activity is new. So will the large financial institutions that now collect massive rents as a result of being centralized hierarchies in a world in which they can extract rents from doing that continue for some time period? Yes. Will they be particularly protected by the areas that are most regulated? Deposit taking and lending? Probably. Will a lot of the stuff around them that they do be taken away by new modes of commerce that render what they do irrelevant rather than replace it? Absolutely.
I think you can take analogies from other internet industry transformations, right? Like the media industry, built new direct-to-consumer models, built new consumption models, disrupted the unit economics of content distribution, all these things. Media companies still exist. A lot of them had to restructure their business models. Yeah. A lot of them did not make that transition, and completely new major platforms were built.
The broadcast companies didn't build Netflix.
Right.
Netflix was brand new.
And AT&T did not build WhatsApp. And so, communications is just a free software service. It's not something you pay for anymore. That's just the new world.
A new paradigm.
And so I very much share Glenn's view on this vis-a-vis financial service utility will shift to these decentralized infrastructures.
So I'm curious, Glenn, what are you investing in?
What am I investing in?
Yeah.
I'm not being paid for this. No, but I'm interested in right now 3 or 4 categories: decentralized finance, what's now called the metaverse, which is basically digital property.
Yeah. Like digital real estate?
Permissionless development and digital real estate, all the stuff inside the metaverse. Identity management and personal data, and infrastructure associated with Web 3.0, and governance associated with kind of DAOs. Those are the 5 kind of categories where I'm looking at as an investor right now.
And he's also an investor in the Celtics.
I am,
yes. You have
yes.
a nice ring there on your
Game 4 tonight. Come root for us.
I also wanted to bring the conversation.
My man Jerry up there, big Celtics fan, front row.
I want to bring the conversation around to the collapse of Terra Luna, a very prolific algorithmic stablecoin. And during that market collapse, Terra Luna and USD had a market cap together of about $60 billion. When that collapsed, we saw something very interesting happen to stablecoins. Tether, which had a market cap of about 83 billion, went down to 73 billion, and USDC went from 48 billion to 53 billion.
54.
54. So I guess the question on the tip of everyone's tongue is, will there be a flippening?
Well, USDC has been growing really quickly for the last couple of years and taking market share. And I think as this technology gets used in more and more applications and more businesses and financial institutions and others use it, they're going to want well-regulated dollar digital currency models like this. And I think when you think about the size of the addressable market, M2 money, it's a big total addressable market. And so the numbers that we're looking at today, 54 billion, 72 billion, are really small, right? The opportunity space here is ultimately in the trillions of dollars in circulation. And that's when this connects in the real world economy. That's when this is connected to commerce and trade and is built into more of the financial system. And that's what we're focused on. We've always been focused on trying to build something for that evolution in the market. And so that's always going to be larger than something that's opaque and offshore and unregulated and has had regulatory challenges and other things. It's just always that's capped in what it can be. There is a market for offshore, dollar shadow banking. There are people who need that product, but I don't think that's what we're building. And I think that the mainstream phase of this is just dramatically larger. So that's the long-winded answer. The short-winded answer is yes, we absolutely will see this flip. But I'm not focused on that per se. I'm focused on how do we build more use cases, more utility, make this easier for people, firms. How do we build the next generation of on-chain infrastructure for capital markets and lending and other things that are going to really bring this to life? And that's really the focus. And I think, per your comments about the market moves, right? There has been a flight to quality, and we've seen not just the numbers on that, but in many, many other metrics and ecosystem participants who are saying we cannot afford another major meltdown. We need to have an orderly way to move from the old world to this other world, and so we're seeing that take place right in front of us.
So look, the way I see it, very broadly described, it's more complicated than this, of course, but there are three types of stablecoins. Yep. Fully collateralized, over-collateralized, and algorithmic. Mm-hmm. I think of, Jeremy can correct me, I think of USDC as a fully collateralized stablecoin. All of these stablecoins have liabilities in the form of what they owe the person who gives them who comes to them to transact. In Jeremy's case, in the stablecoin case, if your assets then are 100% treasury securities, cash, or something that's fully secure, that looks like a money fund. And that has, I think, a regulatory framework that feels a lot like money funds, disclosure and regulatory framework that feels more like a money funds framework. There's another set of stable coins that are over-collateralized where people are bringing digital assets that they hypothecate, borrow money against, and then invest, which looks like a Wall Street loan book. It's exactly what it is. And that happens.
Margin lending.
That happens every day, and it's happened for hundreds of years. By the way, just because they're wearing skinny jeans and Allbirds doesn't mean they're not doing the same thing that happened over several hundred years on Wall Street. Right? They're dressing differently, and they have avocado toast, not guacamole, but it's the same thing, right? And so that's like a Wall Street loan book with an over-collateralized set of assets, and that needs to be managed the way they manage margin loans on Wall Street. Have done it forever. Every financial market since going back to the Egyptians has done that. And then you've got this algorithmic stuff, which I looked at, never understood how it worked, wouldn't touch it with a 10-foot pole. That's what Terra was. It never had any assets to back its liabilities and was, in my view, prone to collapse, which it did. Mm-hmm. That's a very different kind of stable coin than a 100% collateralized stable coin or an over-collateralized stable coin. And you shouldn't confuse the two.
We just think about how do you take government debt money, which is short-term government debt and cash, ideally at the Fed over the long run, and make that a digital currency. And that's what we're ultimately trying to do. And that is a very specific value proposition, which we think is very useful in the world.
Do you find it strange that in DC, policymakers as well as regulators focus their attention on collateralized backed stablecoins, but not really much on algorithmic stablecoins, which were really the one that caused retail investors to lose a lot of money this cycle?
I think a lot of that focus in particular has come from the lessons of the breaking of the buck and kind of prime funds and other things where the Fed had to step in and backstop the entire money market fund industry after the financial crisis. And I think they don't want a repeat of that. And I think the attention, and as a result, the attention is on the things that look like or have attributes that might behave like that, where the underlying assets touch the real financial system and thus could impact flows in the real financial system. Whereas something algorithmic, at some level, like sell-off in crypto asset prices might cause sell-off in other asset prices, but that's that's like market risk. It's different than financial stability risk in the truest of and financial core, dollar liquidity risk or things like that. So I think it's just that's the problem space by which they came at this initially.
So the argument behind algorithmic stablecoins was that it was a decentralized coin that could operate in the DeFi space, unlike CeFi, centralized collateralized backed stablecoins. And I wonder what your thoughts are on, should there, like, the existence of decentralized stablecoins, is that something you would ever be interested in, or something that the space needs?
I mean, look, I think over the long run, various models for price stable units of account that are not based on government debt are interesting. I think those are worthy of pursuit because it's not clear to me that government debt money, certainly in many jurisdictions, government debt money is awful, and I think the U.S. dollar government debt money is pretty good, but you could imagine a world where it's not. And so the idea of stable units of account that are not based on government debt is worth pursuing. I think right now, in literally today, and probably for the next 10 years, reserve currencies that are well established in trade and commerce and the financial system, if you can make those work with the kind of superpowers of cryptocurrency and programmable and all these other things, is extremely powerful and worthwhile. But to make those work and for people to really trust them, they will actually need that underlying liquidity and regulatory certainty, I believe, for mainstream scale adoption.
To use the words algorithmic and stablecoin together is an oxymoron. Right? Because if you look at the assets and liabilities of the balance sheet of the algorithmic stablecoins, there's no assets to support the liabilities. It's not a stablecoin.
It's not.
It's something else.
Mm-hmm. And kind of forms of synthetic derivatives. Sense. Yeah.
But yeah, it's more like a derivative. It's more like it's a mathematical formula that tries to balance assets and liabilities inside a certain kind of environment. But that's not a stablecoin. It's the wrong term to use for what that was.
Right. You should coin the new term for it, Glenn.
We don't call USDC a stablecoin. I mean, people call us that. We've never done that, unfortunately. I mean, not entirely true, but we call it a dollar digital currency. Okay. And that's what it is meant to be. So, I think that word obviously came from, you want something that's not volatile like Bitcoin, so you want something that is price stable. So It is what it is in terms of naming.
Glenn, I'm hoping that you can articulate, since you've seen the early days of the financial service industry to where it is now, can you articulate the future of it with the world of crypto involved and how that will look like? What will survive? Yeah, so
I'm less interested in financial services per se, and more interested in how this new form of commerce. So if the way I see the crypto solution working is you have environments where people gather together to do something of value to them. It can be something that looks like commerce. It can be something that looks like buying the U.S. Constitution. And that can be extended into any number of charitable activities. So I was recently, for instance, on the border between Ukraine and Poland doing a day of volunteering, welcoming refugees from Ukraine into Poland as part of my work for CARE. And the conversation at the border was, how can we set up a DAO to accumulate talent and resources to help mount a relief effort? It's entirely conceivable that you could have a crypto community that could do that. So the way to think about this is not that there's a bank here and now it's going to be a crypto thing. The thing about it is there's a form of way in which people gathered to do commerce in the past that required a centralized hierarchy to offer guarantees to extract rents. The crypto solution, the problem of trust-free exchange, meant that we can actually gather communities together to transact in ways that don't require centralized hierarchies to add trust. And so we can organize commerce differently. Mm-hmm. Right? It's sort of like asking, when Jeremy talked about the early emails versus emails today, is like even though we use an envelope as a metaphor for the button you push when you send an email, it has nothing that looks like something happened at the post office. It's a completely different thing. So and remember, finance is simply a way to support commerce. Finance doesn't have an end in and of itself. It's a way to facilitate commerce. So if we have a different form of computing and a different mode of commerce, and the transactions that happen inside these networks that facilitate that are finance, then that takes away a fair amount of the purpose of the large financial institutions without substituting for them.
Is that why you're invested in the metaverses? Because you see all these virtual worlds and the developing commerce on those platforms. Do you think they'll all survive?
Oh, for sure. Look, if you look at a lot of enterprise technology today comes from consumer technology that's gone into the enterprise outside of the crypto world, right? And so the metaverse is one of the first places in which we see the kinds of activities that can be extended into more enterprise-related or corporate, commercially based kind of activity.
We just need the UX and user experience to be there. And you're investing and acquiring a infrastructure for service to help that along. Tell us a bit about your latest news.
Yeah, absolutely. This morning we announced the acquisition of Cybavo, which is a really breakthrough technology company that builds kind of crypto infrastructure as a service. It's an infrastructure that deals with security, custody, operations, NFT minting and custody, interaction with protocols, DeFi protocols, other things. And it's really, for us, it's technology that's going to really advance our own infrastructure and what we can provide as services and financial services for our customers. But it's also a new product pillar for us, which is we want to enable developers and enterprises that want to build crypto apps and Web3 apps to have everything that they need to be able to do that and really help drive growth in these new, what we think of as crypto apps, which are going to drive the next generation of not just financial services, but games, content, and other categories. And so it's a major new platform infrastructure for us. We're really excited about it. And we'll have a lot more to say about new products that come out of that.
Congratulations. All right. We have the final 2 minutes, and I guess my final questions are for Glenn. And that is, I heard that you had made a sizable donation to Harvard for their African American Center, and so now it's called the Hutchins Center.
Right.
So I'm interested about your interest in African American studies and perhaps its role in crypto in terms of making the industry more diverse.
That's an interesting question. We did a global search for a name and came up with the Hutchins Center. But look, I think what our philanthropy is largely focused on solving some of the world's most important problems that we think are important to us, and we think the problem of race in America is extraordinarily important. You saw what happened in the Black Lives Matter movement, for instance, during the pandemic. We formed a partnership with Henry Louis Gates, Skip, one of the great African-American scholars of all time. And we're going at trying to create understanding and build bridges. In a very similar way, the appropriate application of the sort of technologies that Jeremy talked about can create inclusion in communities that have historically not had banks, been charged very high prices for credit, payday loans, remittances, those sorts of things. And so financial inclusion and fairness and transparency can be seen as a very important part of creating broader social justice and fairness across our economy.
You are also serving on the Obama Foundation. In fact, you have a call with them right after this. So I'm just curious, does former President Barack Obama have any thoughts on crypto?
As I said, if he would like you to hear his thoughts on crypto, he would tell you himself.
I'm waiting to hear it. All right. Thank you so much, Glenn. Thank you so much, Jeremy Allaire, for this. Congratulations on the acquisition. Thank you.
Thank you.
All right.